Going to get to my next guest. He's one of the top-rated analysts covering Alibaba.com. Let's get his view on the results and indeed this possible going back into the, well, the parent company's womb, if you would do. And he is Jiong Shao from Macquarie now. Thanks very much indeed for joining us. Sure. Big miss, but you're shrugging that off, aren't you?
Right. Those results don't matter anymore, as you know. So the company has already announced privatization at 1350. So regardless of what kind of results they print, the shares should be worth close to 1350.
Now, if you've got a share price which is at 1330, tell me about that. Is that because there is an element of doubt that it may not get through?
Yeah, there's always a small risk. Now, remember, Alibaba just announced this morning that the shareholders need to vote next month to be able to, for the company to privatize it, right? And the expected delisting date is going to be in June. So the 20 cents difference makes sense. It is a reasonable premium for the privatization price.
Of course, and they're taking it back into the parental womb, I'm going to say again, because they want to reorganize it and they don't want the prying eye of analysts like you having a look at it and saying, oh, you're doing this wrong and that right, but that's wrong, because they think they know what they're doing here. So how will Alibaba.com look different if it comes back to the market in 2 years' time?
Right. So Alibaba.com is a business-to-business part of the Alibaba Group. As you can see from the results, the fundamentals continue to deteriorate. Now, revenue year-over-year was barely up, and earnings dropped 25%. And the cash flow, by the way, free cash flow dropped 98% year-over-year. The reason
That's phenomenal.
Absolutely, that's a horrendous free cash flow for the company. And we think, at a standalone basis, Alibaba.com worth a lot less than the privatization price tag. The reason they're doing this...
Well, it was well below that, wasn't it? I mean, right. It was at least 6 Hong Kong dollars below that. It was trading before the offer price came in.
Exactly. Now, why they're doing this, we think is a part of the bigger plan for Alibaba Group to negotiate with Yahoo, perhaps to swap some assets with Yahoo to get back the 40% of the group company owned by Yahoo.
Okay, all about you. Yahoo is always the elephant in the room when we're talking about Alibaba Group, isn't it?
Absolutely.
Okay, but the Alibaba.com story, I mean, you said something about the fundamentals here. Does that, is it indicative of the slowdown? Can we have any read-through of the slowdown taking place in China from these numbers?
We can to some degrees. As you know, most of the Alibaba.com customers are small to mid-sized businesses in China, the manufacturers who make the stuff for export. And this part of the business is deteriorating. For example, in Q1, they lost 10% of the customers for that particular part of the business. So you can see that the exporters, the small businesses in China, appear to be struggling.
I want to move now to a company out tomorrow. It's the biggest search engine in China. We're talking Baidu. Now, Baidu's out with earnings. It's not missed estimates, I think, in 11 consecutive quarters, though. It's beaten estimates, I should say.
Right.
I mean, you dispute that slightly, I know, but let's say that on a net basis that they have done that. Do we get another beat tomorrow?
We don't think so. We think the results should be more or less in line as the company guided. No, the expectation is very, very healthy. The company has guided 75% year-over-year growth on top line, and we think the bottom line should grow at the same magnitude. That's very, very healthy. Don't get me wrong. We also think the guidance should be healthy as well.
Now, you know, this company is growing very fast. Is it down to the sheer superior quality of the service it provides, or actually is it because Google's not there anymore and Google's departure means that they've got extra room?
Baidu grew 80% a year for the last 2 years. Partially was because of the market, but partially was because 3 unique factors, we think. The first factor was Google got out of China 2 years ago. Google's market share gone from 20% to 5% in search in China. Second factor was Baidu upgrade its monetization platform 2 years ago. The third factor was the buoyant capital markets for small companies. Those small companies, the e-commerce companies, video companies, they spent a lot of money on Baidu. That has tremendously helped the Baidu.
Jiong Shao, one last point. Okay, we've got these reports here at the moment that Baidu is actually in talks with Foxconn to produce low-price smartphones. What do you make of that? And, you know, is it going into territory it really knows nothing about?
Right. We don't think Baidu is going to be a phone manufacturer or purely phone manufacturer anytime soon. However, mobile is a big trend for Baidu. And Google, as we all know, has come down the mobile trend for the last few years now. Baidu, at this point, need to think about what they do next when the typical online search growth start to slow down.
Thing is, nobody knows how to make money yet properly from mobile search. That's the problem, isn't it?
Exactly. But there are other location-based services, other potential services you can possibly monetize from mobile platforms.
Yeah, build it and we shall make some money sometime from it. Is probably the idea, isn't it? Jiong Shao, thank you very much indeed for that. From Macquarie there.